rates in many countries of the world. The US has about 39.5% as a federal income tax, and they have state income taxes, and in some cities they have a city income tax as well, and a social security tax, and an inheritance tax. We are lucky we don't have all of those. Wealth tax is also gone. The gift tax has gone, save and except that there is a provision in section 56 of the Income Tax Act on certain kinds of gifts. There has been a change insofar as advance tax for individuals is concerned. Up to now, individuals had to pay advance tax in 3 installments by 15th September, 15th December, and 15th March of a financial year. But now, by the 15th of June of the year, you will have to pay 15%, by 15th September 45%, 15th December 75%, and then as the year comes to an end, you will have to pay your 100%. In the case of presumptive tax, to which I will advert shortly, the advance tax has to be paid only by the last installment. You do not have to pay from time to time. Now, if your advance tax is at least 12% by the first installment instead of 15%, or 36% by the second installment, then you do not have to pay interest under section 234C of the Income Tax Act. So you have some little leeway. Also, if an assessee is offering tax under the head income from business, then he does not have to pay any interest if there is a shortfall. Because it may be that a person has been getting only income from other sources, interest and so on, and then he goes into business, so he's not really geared for it, so it is given some facility here. There are several provisions relating to real estate. One of them is section 24B of the Income Tax Act. This has stated for some years now that a deduction will be allowed for interest paid even for a self-occupied residential house. Of course, if you take a loan and buy a property which you give out on rent, then you will get a deduction for the full amount of the interest that you pay. But if it's going to be a self-occupied house, then you are allowed a deduction of 2 lakhs of rupees. The law earlier provided, or till today provides, that the house had to be completed in 3 years from the end of the financial year in which the capital was borrowed. Now this period has been increased to 5 years. There is a new section 25A to take into account certain other sections which have now been removed. This will provide that if the assessee gets unrealized rent subsequently, it could be that your tenant has not been paying you, it could be that there is a dispute, but if you get the rent subsequently, then you will have to pay tax in the year of receipt. You will get a 30% deduction which is available under the head house property, and it will be charged, and whether you own that house or not, it will still be treated as income from house property of the year in which you get the amount, even though you do not own the house in that year. Section 80EE has been introduced, which says that if a person does not have any other residential house and takes a loan of up to 35 lakhs of rupees in respect of a house, the value of which is up to 50 lakhs, and provided that the loan is sanctioned between 1st April 2016 and 31st March 2017, then you will get a deduction of 50,000 rupees in addition to the 2 lakhs of rupees provided for under section 24B. You can see how many conditions there are even for just a small amount like 50,000 rupees. But here also I see some litigation, because it says in respect of a house of a value up to 50 lakhs of rupees. Now value is different from cost. So you may buy a house for 49 lakhs of rupees, but the stamp office may say that according to our reckoner, the value is 55 lakhs of rupees, which does happen a great deal now in Mumbai. And then you will be disallowed this deduction of 50,000 rupees. I'll just give you an example. A few days ago, a person came to me. They wanted to do a transaction for about 6 crores of rupees. And the stamp value was 8 crores of rupees. The result of that is that not only does the buyer have to pay pay stamp duty with reference to the full 8 crores, that means 5% of that additional 2 crores, but the buyer will also have to pay tax under section 56 on that shortfall, Now it will be a 35.535% if it's an individual, or 34.608% if it's a company. So say 34 or 35%. And the seller would also have to pay tax on that shortfall of 2 crores of rupees. Since the seller was making a long-term capital gain, the rate of tax would be about 23%. So you can see that the total on account of the difference between the reckoner value and the actual transaction value was 5% plus 35%, that makes it 40, plus another 23%. So 63% is what one government or the other gets, even though there is no black money involved at all, even though we know that the transactions officially is being done at the full official price. But the government valuation is different. Now section 80GG provides for a small deduction for rent being paid by an employee who does not get a house rent allowance. If a person is employed and gets an HRA, then there will be some concession and some taxation. But if a person is just getting a consolidated salary and he is paying rent for his own house, then he was getting a 2,000 rupees per month. This will now increase to 5,000 rupees per month as a deduction. A new section is to be introduced, section 80IBA. This is for housing projects which are only for the purpose of affordable housing. Now, how is affordable housing defined? Well, that's a strange thing. It says that in the 4 metros and for 25 kilometers around those, and now they take the distance as a crow flies and not by road. So, for 25 kilometers around also, it will still be treated like the city of Mumbai, for instance, and it's only a 30 square meter apartment that will count as part of affordable housing. That comes to about 321 square feet. Now, 25 kilometers around Mumbai is so far. If, for instance, you go by boat to Mandua, that's about 12 nautical miles, so it comes to about 18 or 19 kilometers. And you go another 6 kilometers beyond, some of the people may not even have heard of Mumbai, but it's still treated as part of Mumbai, and even there only a 30 square meter house will be treated as affordable housing. In other areas, and here also they say, in other municipal areas or cantonments, they do not talk about villages. So if you want to do housing in villages, affordable housing in villages, well, that won't count, you won't get a deduction at all. So it is only very limited, as you can see. This is what happens in all these deductions. You saw how many conditions there were in the earlier section, and now again in this one, there are so many conditions that are imposed that it becomes very difficult to work around these and to allow the law to actually be fulfilled. In Mumbai, for instance, the only housing of this size that you will get is in a slum redevelopment scheme. Even there, the minimum area that you have to give to a slum dweller is about 296 square feet, which is just little short of the 321 that this law proposes. And that, when you do make that affordable housing for slum dwellers and you give it to them, you're not supposed to charge them because you're supposed to give it to them free. So that's a cost center, not a profit center. This deduction is available only in respect of profit centers. So actually practically no one in Bombay is going to get this deduction. Outside Mumbai, however, there may be some areas where one will be able to construct flats of 60 square meters and below that, and then be able to get 100% deduction. But here also, it says that the first approval has to be taken between 2016 and 2019. So if you'd already got your approval earlier before the budget was announced, sorry, you're out. You don't get the benefit at all. You have to get the approval after the budget and before 31st March 2019. And you have to complete your project within 3 years of getting the approval. Now they've also said that you may modify the approval because sometimes you submit one plan and then after that you want to change your plans. It's the first plan that will be relevant for the purpose of determining whether the conditions are fulfilled or not. So if you do get your first approval, let's say in 2016, and you go for a second approval, a modified approval in 2017 or 2018, Well, you will not get 3 years' time from 2017 or 18, you'll still get it only from 2016 because that's the one that actually counts. Other conditions are that the land should be at least 1,000 square meters in the 4 metros and at least 2,000 square meters elsewhere. Another condition has been put, which is, I think, logical because otherwise there were many houses which were being made as modules which could be connected to each other. And such a provision was there in section 80 IB 10, which is now no longer there. This says that if one person buys a flat in such an affordable housing project, then his spouse or minor children should not buy another flat in that same project. That will serve to disqualify the builder from getting this concession. So you have to be very careful if a person comes to you and it may be that a lady gives her maiden name. Suppose she's not using her married surname. But you have to ask her, are you married? What is your husband's name? Has your husband bought a flat in this project? And only if you're sure that both of them are not connected, then you will get a deduction. Of course, they haven't provided for engaged couples who subsequently get married. So you do not know what's going to happen there. The concept of REITs, real estate investment trusts, has been talked about in India for many, many years now. SEBI has introduced regulations as well, but these have not been acted upon and REITs haven't actually started functioning. Why? Because the tax laws were not clear. They have not gone in tandem. Now, one change has been made, and that is in section 115O, subsection 7. This says that there will be no dividend distribution tax on amounts declared by a specified domestic company by way of dividend. Now, what will happen is this, that suppose a real estate investment trust is set up. That may be set up outside India or it may be set up within India. Such a REIT is allowed to buy property in its own name or may buy property through a company. Some would prefer to buy it in their own name, but many others would prefer to buy it in the name of a company in order to get limited liability. Suppose it buys in the name of a company. Then normally a company would earn its income and pay tax, as Chair pointed out to you. That tax is about 34% or so. Then the company, when it declared a dividend, would have to pay a dividend distribution tax, which is also a substantial amount, about 20%. The provisions in relation to REITs already say that a company, when it pays interest to the REIT, does not have to deduct tax at source, and that interest is not taxable in the hands of the REIT, but can be passed on to its investors. But there was no such exemption in respect of DDT, dividend distribution tax. So now the law is to be amended to provide that when the specified company, that means the company holding the asset, holding the property which is earning rent, etc., pays a dividend distribution tax, pays the dividend, then there will be no DDT. The REIT will receive that and will be able to pass it on to its own shareholders or investors, and they will have to pay tax. Now again, I think this is going to result in a problem because the SEBI regulations say that the minimum holding of a REIT in such a specified investment company has to be 50%. So REIT can hold 50% or 55% or 100% of such a company. It's not obliged to hold 100%. And yet the Income Tax Act will say that it is only if the REIT is the sole shareholder or if there are one or two other shareholders required for operation of law. For instance, many companies need to have at least 2 shareholders, or a limited company requires 7 shareholders. Then the condition will be deemed to be fulfilled in substance. But if the REIT holds 50% or 55%, even though it qualifies under the SEBI Act, it will not qualify under the Income Tax Act, and therefore the dividend that is distributed by the company will be subject to dividend distribution tax. So again, I think that there's going to be a problem. It could be, for instance, that a REIT invests, say, in 80% of a project. Or a REIT has a company which holds 80%, and some other investors, maybe the developers themselves, hold 20%. Then it will not qualify and there will be a DDT. So I feel that this is again something that they need to look at in order to encourage investment. Section 50C of the Income Tax Act was introduced several years ago. This said, as I mentioned earlier, that the reckoner value of a property for stamp duty purposes has to be adopted for income tax purposes as well. We do find a lot of discrepancy. We find that the reckoner values in some areas are much higher than in others, and much higher even than the actual transaction price. Nariman Point is an example. The reckoner value is about 34 or 35,000 rupees. There are actually transactions at 26, 27, 28, 29,000 rupees right now. So all the parties suffer. Now, Section 50C applies to capital assets. Section 43CA was introduced later, but this applied to stock in trade. So if a builder was selling, and if the selling price was lower than the stamp duty reckoner value, then the builder has to pay a tax even on the deemed profit, the difference between the reckoner value and his selling price. Fortunately, in Section 43CA, there was one subsection which said that if an agreement had been entered into at one point of time in 1 year, and then the transaction was completed in a later year, then as long as some money had been paid before the date of the agreement or on the date of the original agreement, then the value in that year would be taken into account. Let's take an example. Suppose a builder started constructing a building in the year 2010, and the building is still going on. Now in 2010 he entered into an agreement to sell, let's say for 1 crore of rupees. And the reckoner value at that time was indeed 95 lakhs or 1 crore of rupees. So the buyer paid some 10% or 20% earnest money. Today when they want to go and register the document, they find that the reckoner value is now 1 crore and 50 lakhs of rupees. There's no black money in the transaction, it was official, it was well above the reckoner at that time. It just happened that the builder took time to prepare the documents, to prepare a MOFA agreement which needed registration and so on. And therefore the flat purchaser suffers and the builder also suffers. But because of 43CA, the builder would not suffer. However, in the case of a capital asset, suppose an individual were to sell and he had entered into his agreement in 2010 and completing it now, he would have a big problem. So now they are introducing a provision in section 50C, similar to that in 43CA3, which will provide that as long as an agreement had been entered into and some money had been paid on the date of the agreement or before the date of the agreement, then that year's value will be taken into consideration and not the value in the year of completion of the transaction. So this is a very salutary amendment and will help a lot of people who have otherwise had litigation. Tax has to be deducted at source on rental payments. This is under section 194I. And the rate of tax is 10%. Now, it often happens that a person who is letting out a property will get a deduction firstly of 30% because that's a standard deduction for letting out of properties. He may also get a deduction for interest paid if he's taken a loan for buying the property, or he may have other losses which he wants to set off, etc. So it often happened that the 10% that was being deducted by the lessee was much more than the amount of the tax which the lessor would have to pay. Up to now, he would have had to go to the ITO for a certificate under section 197 of the Income Tax Act, and that will take its own time, that won't come at the beginning of the year, and the ITO may not allow it fully. But now they are actually simplifying this and saying that a lessor can submit Form 15G or 15H in order to avoid TDS. So this will also simplify. There are some other deductions under the head business. Section 36(1)(7)(a), for instance, will provide that a non-banking financial company, an NBFC, can claim a deduction not for bad debts alone, but for a provision for bad debts. If a company or any assessee carrying on business has a bad debt in the course of business, he is now allowed to write it off. But an NBFC now can write off, can claim a deduction even for a provision for bad and doubtful debts even before the debts have actually gone bad. There are already provisions for presumptive tax in the Income Tax Act. Up to now, the position was that if a business had a turnover of up to 1 crore of rupees, then the presumption would be that the income from that business is 8%, and therefore one could pay tax on that 8% of the turnover without having to prepare books of account and having to explain those to the Income Tax Department. Now that limit has gone up from 1 crore to 2 crores of rupees. There is also now a new presumptive tax for professionals under section 44 ADA. This says that if an assessee is resident in India and engaged in the profession and the gross receipts do not exceed 50 lakhs, then the presumptive tax will be at 50%. This would apply to engineers, architects, lawyers, interior decorators, technical consultants. So if, for instance, the turnover is 40 lakhs of rupees, then he could just, if the gross receipts are 40 lakhs, he could pay tax on 20 lakhs of rupees. But I discussed it with my chartered accountant and I asked him, what difficulties have you been facing in this? Of course, there's been no presumptive tax for professionals so far, but there has been for business people. Suppose, for instance,